Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, February 23rd, 2022. And what we're going to do is take a look at the equity markets here, and I'm going to show you something I haven't covered in a little while. I'll talk from time to time. I'll touch on some of my various trend indicators, both short and long term, and that's what we're going to look at today. I'm going to do a quick recap of the market and where we're at. So here's that first target zone, which we hit the bottom of, which was also the single target on the QQQ weekly chart, and we hit that on the 24th. And since then, as expected at the time, and since we got it, reaction off the initial tag. That's usually why, that is one primary reason I list multiple targets. Each one is an area we're likely to, again, upon the initial tag at least. Sometimes you get multiple tags, you're likely to get a reaction. And of course, as I often say, support is support until and unless broken. So since we hit it, bounced, maintain that we need to come back in and we need to take out the lows. And ideally, not just on QQQ, well actually, absolutely on SPY, the S&P 500, the Dow, if we're going to go on to hit my next targets. Let me just jump over to that for those of you just catching up now. This is my weekly chart of QQQ, and I have dual trend lines. One comes off the low of, is technically speaking, the NASDAQ 100 bottom in November of '08. Every other index bottom in March of '09. But the trend line works perfectly. So that's the trend line on QQQ. Then I have an alternative trend line also once we had that, off the bottom of the end of the bear market there, the new bull market. Things kind of normalize from this point, and I have another trend line, an alternative trend line. The thing is, they come in roughly together, and they coincide with what is really my fourth and final target at this time. And I've been referring to it as for months now. Even when we were topping, this was potential T4, and I'm going to, if we get down here and we solidly take out T1, and let me just say it now, if we get down to T2, that is, the potential will be struck out. It'll be an official target because the odds, as each support level is taken out, it opens up the door for a move down to the next one. And because of this, and the reason I'm doing this video today, if and when we get to my second target, which is down around 299.15, you can call it 300 on QQQ if you want to round up, that's going to cause additional sell signals on some of the longer term indicators, which then increases the probability we're going to go down, and increases the probability that instead of just a correction, which is all this has been so far, that it will could quite likely be early stage bear market action. Because that target, if hit, and I've just measured down to roughly that 235 line, which by the way is the it's really where we peaked right before COVID hit back in February of 2000, or I'm sorry, 2020. That comes in with those trend lines, particularly that that blue one down there, and so that's where I think we're most likely going. And so far we hit my first target. I measured at roughly 16%. I did that back, I believe, well, yeah, it was off the highs. So I think it's been 18% so far because we overshot that first target by a hair. And then T2 is about a 27% drop off the highs. T3, I know it's hard to see here, is about a 34% drop. And then T4, 42 roughly, again, ballpark figure. Okay, so back to the daily chart. And before I leave the weekly chart, just to reiterate, we have not just on the NASDAQ 100, but the S&P 500, we have a bear flag continuation pattern that's set up on that expected bounce off T1. That formed what appears to be bear flag continuation pattern there, and like you want to see, you've had nothing but selling so far on this weekly chart. Once we broke down week before last, we broke down, red candle, follow through, red candle, and so far red candle. But we're at a pivotal level right now, and that's why I'm doing the update. That was the low. Let's turn off all the lines here. I just jumped over to a daily chart. So there was a low on QQQ on the 24th of January, and that was at 334.15. We made, for all intents and purposes, a perfect test yesterday during the regular session. We hit a low of 334.35. So you're talking 20 cents. We missed the low by 20 cents on a $334 security, which is, that's about 1/3 of 1/2 of 1%. It's a fraction of 1%. Again, so a small fraction of 1%. And therefore, that's for all intents and purposes, we've been testing that. And again, today, we hit a low today of 334.42. And so, I mean, you can see there clearly. So we're testing those lows. SPY's holding up a little bit better. They're still, it's above the reaction low from the 24th. You can see right here. But again, so if we undercut those, and again, talk about things that I always try to point out if I'm missing something or possibilities. Remember, I only speak in probabilities, not possibilities, because anything's possible in the market. So right now, there's still a chance for the bulls to come in and even undercut those lows. So when I talk about taking out the recent lows, I have to acknowledge, and quite often, in fact, more often than not, if you have a successful test of a previous low, you'll undercut it, clear out the last of the weak-handed longs, run the stops. So it would not be. It's certainly in the realm of possibilities here to see an undercut there, and if so, we have positive divergence for the first time in a while on the daily chart. So break of those lows could be a false breakdown. I don't think it is. I'm going to tell you, I don't like wishy-washy analysis. That's not my point to tell you that's possible. Point is, hey, if you see it and it happens and they start buying it impulsively, at some point you may need to, well, you will need to, if you are short, consider a stop. And if you're a bull, then you could, what I wouldn't do, I wouldn't take the breakdown of the lows, but if you see a breakdown and then a sharp recovery back above, then you can position long with a stop below that recent reaction low. I like that strategy if I see what I believe to be a false breakdown. As of now, I'm sticking with the bearish scenario. And so, like I said, I'll give it a little bit of room. Volatility is the norm lately. That's another thing to successfully trade a correction or a bear market or even an explosive rally after a correction's over. Volatility is high. If you're using tight stops or if you're second guessing your position every time there's a 3, 5%, 6, 8% rally against it, depending again, when I'm speaking 8%, depending on what you're looking at. If you're targeting a 20 to 40% drop in the Nasdaq 100, you need to allow wider stops. If you're just trying to game the quick pullbacks and in shallow targets, you need to use more tighter stops than you would if you're trend trading right now. So I'm speaking in trend trading mode is what I'm talking about now. SPY target down there about 395. The next target ultimately come down here about 354. And then there's that low from the pre-COVID highs about 340. So we'll call that a comparable target zone on SPY. Here, I'll put a line there. Again, I don't trade SPY. That's why I haven't labeled the targets there for you. All right, back to where we're at. So most importantly, I'm putting a lot of my emphasis on the Nasdaq 100. And both positioning as well as the impact on the market, because it is a better proxy because it has a much higher concentration in the market leading FANG stocks, and so it's again one of the best proxies to get an idea, because when tech breaks, it is, although it's not half of the S&P 500, it is half of the Nasdaq 100. It is the highest weighted index sector, I'm sorry, at about 25%. A full 1/4 of the returns of the S&P 500 is attributed to the tech sector, and that of that, most of the weighting comes from Apple, Microsoft, Amazon, Tesla, Alphabet, and Facebook, those big things. All right, so that's it. Let's not beat a dead horse. From price perspective, we do have the divergence. I just jumped down to a 60-minute chart. See, there's that low. We tested it yesterday and again today, and that gives us positive divergence all the way out here from the 60-minute chart to the daily. And normally in a correction, this is where I look to cover all my shorts and reverse to long position. I love these divergent lows, especially on the 60-minute time frame. All the better that you have it on the daily chart. But I'm going to go over some of my long-term trend indicators now, and it is, I can tell you clearly, it is what I'm seeing on the longer term charts, what I'm seeing in sentiment indicators. In fact, probably 80% or more, I don't know if it's that number, but a good percentage of what's keeping me short and leaning towards these divergences being taken out instead of being the catalyst for the run to the next highs and beyond is a lot of what I'm not going to cover today. Just too much in this video. We're going to stick to the trend indicators. Just want to show you We're there right now. We're testing those recent lows. First, looks like if we do break it, it's going to first break in the Nasdaq 100. Then you want to see it taken out in the S&P 500. You can certainly take a shot if you see a break there, especially if it's impulsive selling, especially if it looks like we're going to close the day well below there. And then, like I said, my really all-in moment, or let me just be more clear, the moment where I think the odds go up even more significantly that we're going to hit those deeper targets I have, is when, if and when these divergences get burned through on both the 60-minute chart and the daily chart by taking out these previous lows. Then if we take out the previous reaction lows, you no longer have negative divergence. And you guys have heard me say, if you followed me for a while, I always say fewer things in trading and investing are more bearish than a failed breakout, a failed long side bullish breakout. Well, just like that, fewer things are more bearish too than a beautiful setup. Again, I wish, part of me, if I didn't see what I see on the long-term charts, I would be bullish here, and this is one of the best setups I've seen. I pointed out these divergent lows on the 60-minute chart for a while, and we even had one back there, and it led to a good rally. But that rally was sold into. So I'm seeing a change of character, and that is in a bull trend, 60-minute and especially daily positive divergence, oversold conditions are exactly what you want to see when you're buying a dip. Those are usually the next, the catalyst for the next highs, the net rally to the next highs. But and likewise, in a strong bull trend, negative divergence, bearish chart setups, they have a much higher rate of failing or not playing out at all and being burned through. And so the inverse happens when the trend changes. So we all see what we want to see. Bulls believe that this is just a correction in an ongoing bull market with a lot more to go, just a little adjustment period for the fact we know rate hikes are coming. And again, most of the pundits, when I do, the few times I'll read an article, check the news headlines, or turn on the TV, which is rare. Most of them believe we're looking at slowing but still positive economic growth this year, and the stock market being up, and this being a buying opportunity, et cetera, et cetera, et cetera. So one of us will be right and one will be wrong. All right, so that's it. That's where I think we're going, and we're close to it. That's why I'm doing the video. Now let me go talk about some trend indicators here for you. Before I leave this chart, one of my, we're going to go to a different chart, set of charts, but a couple things to note here. Let me just turn them up for you. Some of the most simple and effective, some of my favorite moving averages. It all depends on the time frame, the chart, even the particular security, but the 200-day moving averages do a great job. I've talked about that, and it can be shown better when you go to a weekly chart, turn off all the lines. When you go to a weekly chart, you want to set a 40-period moving average. I have the simple in blue, 40-week simple moving average, and the 40-week exponential. And they do just a great job of defining bull and bear trends. Bullish when you're above it, and they act as support when you pull back. But once you break it, like you did there when COVID hit, you did in the big fourth quarter 2018 correction, and so forth and so on. So usually when the indexes are below those levels, and you can see back there all the way back to the year 2000 right here when the dot-com bubble it peaked, then popped. We took out the 200s, stayed above them throughout the bear market. Every time we came back to backtest, that's when you should have shorted. But finally, we took them out right here, and that started a new bull market. So you can look at these as simple trend indicators. Even better, I love this monthly chart here to put up a 20-period exponential moving average. Let me turn off all the trend lines. It really doesn't get any better than this one. If you wanted if you rate indicators on a combination of their effectiveness as well as their simplicity, so you can get really complicated, use multiple indicators, multiple moving averages, but this is one single moving average. It's the 20-period exponential moving average, and it does a great job, and I've talked about it before, and used in conjunction with other trend indicators. That's the key, guys. Wouldn't ever trade solely off one single indicator. If you put a gun to my head and that's the only option, it's the only availability that I could get from any charting platform, yeah, that's all you have to use. But you don't. The beauty is there are multiple trend indicators. I'm a big believer of the KISS rule. Keep it simple, stupid. If you're new to this and starting out in trading, don't try to learn and manage dozens of different indicators. try them all, see which ones mesh with your trading style, and then incorporate and just focus on a handful. Know them well, know them like the back of your hand. And in this case, I use, that's one of them for long term. And again, this is a monthly chart of the SPY, the S&P 500. And this PPO histogram right here, which is the red and green lines, when it crosses over, the PPO makes a bearish cross, the histogram goes red. It shows you the biggest corrections. And but when used in conjunction here, see that whipsaw there, you wouldn't have gotten short. It would have corrected back down to the 20-month. It does a great job of acting as support. Boom, 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 boom in bull markets, right? And when you lose it, you're in a bear market. At that point, you turn around and you short rallies back into it. Maybe this could even be considered your 401k, one of the great tools using your 401k, because these are monthly candles. This doesn't happen quick. You got to wait for a monthly close, and it tells you get out of equities if that line crosses. And if you're a trend trader, you want to short bounces back to it, but once we regain it, that's when you want to be long again. Your 401k should be in equities. And look, once we regained it, support. These are multiple candles. I don't know if you can see them on the video. Perfect text. You're looking at either the body or the wick, and again, it's the monthly close. How we close the candle at the end of the month. And so you can see, boom, bear market. We back tested after we dropped below it. We back tested and never looked back. We regained it here. We're in a bull market. Bull market there. We went through it intra-month, but all these right here, you close back above it. Boom, 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 boom. A lot of intra-month. We got stick saves. We rallied back up after dropping down below it, either a hair below it or closed right back on it or above it there. And COVID hit. We were below. No, that's the fourth quarter 2018 drop. There's COVID. We had to close below it, but look, we regained it the following month. And that's where we're at right now. You can see, you know, I got to caution. Sometimes, you know me, I'm what I call self-described anticipatory trader. A lot of traders, what that means, a lot of traders will look at a pattern, let's say a bullish falling wedge, and they wait for a breakout because it's your buy signal, right? A breakout above the wedge. Well, at times, I will anticipate if a breakout's going to happen and position ahead of it, especially if other things were at support. If there's enough evidence that we're probably going to break out, I'll do that. And in this case, what I'm getting at here is you can anticipate a lot of times one of these crossovers before they happen because simply the PPO starts rolling over. Rolling over means the slope goes from positive to negative. Any line, that's a zero slope. That's going back to whole mathematics 101. Positive slope is if a line is pointing up, negative slopes when it's pointing down. So when you roll over, the slope goes negative, means the lines are rolling, heading down, and sometimes they kiss and you keep the trend intact, but quite often and usually once you roll over, especially this one, you can see the PPO headed down right there, and you already have the crossover in this case. Now it hasn't finalized this month. This is a monthly chart, but look at it right now. This is the histogram looks. We're at February 23rd. It would take some crazy rally to undo this pending sell signal. It's again pending the final trading day of the month, but it looks almost near certainty that we're going to get it. And again, that we also then want to see this 40 or 20-month exponential moving average go to give another check mark for not a correction. At that point, we're going to be in what I believe to be early stage bear market action, and that's going to sharply increase the odds of my maximum, my final targets that I've given you being hit, which are talking again, we're talking a 40-something% drop in the NASDAQ 100. So, you know, heed the warning. Maybe it happens, maybe it doesn't. There are no certainties in trading. I always say that. So that's it. With a lot of evidence here on this chart. And now we're going to go and look at something else. Okay, this is a chart template I have saved. I call it my quad trend indicator. And as you can see, I know you can't see them in the video. I'm going to expand and just look at these one at a time. And I could go through every index. I can tell you that the NASDAQ 100, which I view as the leading index, it's the tech sector, tech stocks, is certainly had triggered earlier sell signals. We'll take out those recent lows if they are going to be taken out before the S&P 500. So just know that the S&P 500 is a little bit behind. Time permitting, I'll jump on that real quick and cover that. Maybe cover the small caps as well. But we're going to start out here with QQQ. And so what we'll look at here is the from bottom left, work our way up. And again, these are just some, not all, but some of my trend indicators. This is the shortest term one on that particular layout of 4 different time frames. Actually, 2 are daily, and then we have a weekly and a monthly chart. So this is a daily chart of QQQ, and there's actually 3 different trend indicators on here. Number 1, and again, I give high marks to any indicator that for simplicity, because again, you can get as complex as you want. You know, you want to get super complex, you just, you know, become a math genius and write algorithms that trade the market. That's what a lot of trading is done today. And those are, you know, on the far end of the spectrum of complex, but that's basically the same kind of thing. A lot of math and variables and inputs here. So you want super simple. What you have here is in blue, the blue line here is the 20 period. So 20-day exponential moving average. And simply, I use it in 1 of 2 ways. I'm going to zoom in a little here. Number 1, behind it, you have QQQ in the black lines. This is just a line chart, so that's only going to show the daily close, not candlesticks. It's just easier looking at this trend indicator. But 2 things. I look at the slope of the line. Again, remember, when a line's going up, it's a positive slope. So when the line crosses down, that is usually a short term. Again, it's my shortest term trend indicator on this particular layout of charts we're covering. I have much shorter term ones on you know, shorter term charts. But this one, 20-day, and you can see, you know, crossed down there, and we're in a correction. Told you, you're in a correction. Turned up here, and you can see the S&P 500 rallied from there. Turned down right about here, and there was a correction. So, and it also often acts as support and resistance, but more so I use it for looking at the slope. So you can see here the slope changed from positive to negative back here, and it's still clearly negative. So that one trend indicator is clearly bearish right now. It flipped down there, and it was bearish, and it caught most of that correction back then. Right, so it does a pretty good job. And another way to use it is whether or not the NASDAQ 100 is trading above or below. So right here, you cross down below right about the time the slope changed, but the NASDAQ 100 crossed down below it and remained. And look, you had 2 instances where it tried to gain it back tested from below, and it acted as resistance. It rejected, and there it acted as support. So that's one. Down here, I also have a combination. These are pairs of moving averages. I've created, years ago, I figured out how to create custom histograms for any moving average pairs. A lot of traders that use moving average pairs will have, like, let's say the 20 right there, and then they'll also have another one. Let's say, in this case, I have a 39 and 13. But they'll have them up on the board, and then they have to look to see when they cross over. Because when you have the faster moving average, in this case it would be the lower number, the 13, cross down below the slower moving average, which would be the 39, they call that a death cross. And when the slower moving average crosses back above the faster one, the faster crosses above the slower, that is a golden cross, which is bullish. Now, what I did, instead of putting a bunch of lines here, I just created these histograms, which just show you when they cross. The histogram just calculates, the way I have it set up, it calculates the differential between the 2. So when the histogram is really high and green, it means that 13 is really far above the 39, and when the histogram starts to drop, it shows you they're about to cross, and once it does cross the 0 line down here, it goes from green to red, that's when the 2 crossed over. And that also acts as a trend indicator to show you when, you know, bullish and bearish trends start. And you can see that it's clearly bearish right now, as is this other one. I have a 26 and 13. So I just wanted to share that. Again, I'm more of a short-term trend indicator. And let me flip over to the next one here for you. That would be this one. We're also going to look at a daily chart with a little bit longer-term trend indicators here. I'm going to zoom in a little tighter. And so there's actually 3 moving averages on here. I have the 200 turned down. I'll turn that up in a second, but let me show you this one. These are popular moving averages as well. You have the 50-day exponential and the 20-day exponential. Remember, they're a little bit faster. On some charts, I like to use the 50 and 200, and I'll show you that here. So what happens is you look at crossovers, and right here you had a bullish crossover. The 20 crossed the 50. That's the remember, the green line is the 20, the red's the 50. 20 is going to respond to prices quicker, and it said, okay, the trend changed from bullish to bearish. You can also see that visually represented down here in the histogram. That's the 2050 histogram. Again, it's showing when these two lines cross. So it said buy. And when they're trading, when the 20 is above the 50, the trend is bullish. And it said all along here, the trend was bullish. You had one little whipsaw right there, but it got right back into bullish. And so pretty much it told you to be long the that one trend indicator. Again, it's not a be all end all. It said be long the NASDAQ 100 up to this point. Then you had a bearish crossover right here. Yes, it proved to be a whipsaw. We got right back above it. So even if you got out of your longs and shorted on it, you lost minimal on those two whipsaws, and you captured 99 or 95+% of the entire trend up to the recent highs. And here's the thing, guys. When you start, as I'm doing, I'm walking out right now to longer term trend indicators. There's pros and cons. The shorter term trend indicators are going to get you short or long faster. They're going to get you into longs and out of those longs quicker. But the downside is you're going to have more whipsaws. As I get to my longer term trend indicators, they're not going to get you in at the exact bottom, out at the top of your long positions, or vice versa on your shorts. But what's going to happen is they're going to have much fewer whipsaws. And so therefore, if you don't do this full time like me, you might want to put a pretty big emphasis and pay attention to the longer term trend indicators, especially for your 401k type monies and stuff like that. All right, so here we are. We had a bearish crossover there, and they're not common. This is, here you can look, see the histograms, see the periods that it got you out. They warned you, they got you out of the market throughout most of that drop in the fourth quarter of 2018. Again, didn't get you out at the exact bottom, but I did, based on other technicals, trend line, positive divergences, 60-minute chart, trend line breaks, we hit targets. And so I use these in conjunction with everything else. And what I'm trying to do now is paint the bigger picture and also warn this trend indicator. I'm rolled back years here. You don't have, there are some whipsaws, but not many. And it's deeply red right now. And the only time that we've seen it in recent years, this red, are during big corrections. And remember, once again, all we've seen, in my opinion, since 2009 are corrections within an ongoing bull market. Yes, COVID, technically the 36% drop from high to low in the S&P 500, you could call a bear market, but I've made the case before that we haven't seen a real bear market since 2007 to 2009, and the only one before that was 2000 down to 2002. All right, so this could be, you might, I say that because you might look at this and say, yeah, Randy, you know what, you were right, that's a good indicator, but it's about as long as these were, the correction, so it should be over soon. Hey, maybe not. If we're in a new bear market, then it's going to look, I don't know if I can roll back that far. No, not on this one. This is going to stay red a lot longer. Okay, before I leave the board, I have one other moving average here, the 200-day exponential moving average. I need to turn it up so you can see it a little better, and that's in blue right here. And one of my favorite pairs is the 50 in conjunction with the 200-day. And when that crosses, I might have that, I don't think I have it on another board. It's a pretty powerful trend indicator, and you can see that a lot of times those moving averages, again, when you use these pairs, they act as support. The faster moving average will come in and correct. It came down, looked like you were going to get a bearish crosshair, but they didn't. It bounced. The 50 bounced right off the 200, and it kept the trend intact. So the last time that these two crossed and gave you a sell signal was back here in the fourth quarter of 2018. During COVID, it didn't even give you that sell signal. It kept you long, so to speak, again, if you were using solely this trend indicator, or at least it didn't confirm. And that's because that 36% drop, and it was less than 36 in the NASDAQ 100, it was 36 in the S&P, happened so fast when the Fed stepped in, and we came from such high levels to get down there. That's why it didn't cross. I just wanted to say this is a pretty effective indicator. If I could scroll back, I would. I'll have to go to a weekly chart to replicate this. You'd go down and you'd do a 40-week and then just divide that by 5. That would be a 40 and 10. There's 5 calendar days in a week, so when you go to a weekly chart, a 40-week, a 40-period moving average is the same as a 200 on the daily. And likewise, just divide that number by 5 and give you a 10. Okay, so that's, and again, it looks very likely. Let's just say that. Again, sometimes they kiss, but it looks like a bearish crossover is likely and likely to happen soon, especially if those lows that I've highlighted and harped on for a while give way. Next up, we go out now to a weekly chart. And on here, I have the 17-period exponential moving average in green, and I have a 43-period, again, 43 weekly exponential moving average in purple. And there's the histogram. Again, you know what, let me make this a little brighter for you guys to see. Let me change the chart background color. Hold on one sec. Okay, that's a little brighter. Hopefully you can see that in the video here. And let's roll it back, because this one we're on a weekly chart. I can go back all the way here. There's no point me going down and highlighting these lines. I can tell you that this one works really well. And again, when the histogram is green, it's just showing you the differential between the 43 and 17 period moving averages on the weekly. All along here, it said you were in a bull market, be long and strong. That was the .com bubble right there. Kept you in it. All the pullbacks, never, not one single whipsaw throughout that. That was one of the strongest bull markets in history, especially over such a short time period from 95 to March of 2000 when it peaked. NASDAQ was clobbered down over, gosh, about 80%, really big correction. And guess what? It did a pretty darn good job. Again, we're on a weekly chart, so it's not going to get you out of your longs at the top, but it told you about this point early on, get out. We had a trend change. The trend is now bearish, and it told you the trend was bearish up until this point where it said bear market over, new bull market is underway. You had one whipsaw right here, brief. And again, even if you followed it religiously and got out of your longs and then back in when it turned green, you would have only missed a blip of that bull market. That was a pretty decent bull market. It was 2002 up to 07. Then came the Great Recession, the housing crisis, and everything, popped everything bubble pretty much. We had right there, the histogram, the lines crossed over and back tested there a couple times. Said bear market, get out, and then told you to get back in there, and it told you to stay long all the way to this point. We had a little blip right there. Again, called a whipsaw. I will, because that's pretty much what that was. Another one there, called a whipsaw. But other than that, it said be long throughout this entire thing. Now, where am I going with this? All right, well, we're still, again, we're out on a weekly chart now. You're not going to see this thing flip over at the top. That's what I was telling you before. But you can see that, number one, the slope has rolled over, the slope of the line, just like it did right here. And if you look at just that alone, when the green line I'm talking about, the 17, the faster moving average, if you got out then, you sidestep that big drop there, and likewise, so forth and so on. Right there, same thing. Slope peaked and turned down to a negative slope and got you out throughout most of that drop in 2018. And likewise back here, you can see it's rolled over right here. About when, it was giving you sell signals, the original sell signals were all back there on the top, but that's when this trend indicator, at least the line rolled over, the slope went negative. And now, we haven't crossed over yet, but that's something I'll be watching for. And if we go on to hit my second target, you'll probably get that. And then again, the takeaway is if my second target's hit,
it kind of then has a domino effect. It rolls over some longer term indicators, and although I'd still put odds right now. It's hard to say if and when we get there, if I'll be reversing from short to long for a bounce. We don't always bounce on, especially with what I think might happen soon with the waterfall selling. We could blast right through T2. It's possible. We'll see. We're not even there yet. We haven't even broken the first target support yet on QQQ, so I don't want to get ahead of myself. But I do want to say this is what I'm looking at here. We're seeing these long-term indicators roll over. If I've talked about pullbacks and short opportunities since COVID hit, none of these long-term indicators, these all were solid right there. And you can even see the NASDAQ 100 pulling back to that line on multiple occasions. It acted as support. So there's so many useful values or different ways to use these moving averages and trend indicators, and that's one of them there. And again, when you cross down below, which we did there, the slope also went negative, and we crossed the NASDAQ 100 crossed down below it and remains below both of those lines right there. All right, and if I haven't bored you yet, we'll just wrap up here with the longest term trend indicator, which is, let me change that and make that lighter as well. This is my monthly chart, QQQ monthly. And up here I have a 10 and a 6 period moving average. And that also defines, this is again a monthly chart, long-term stuff, finalized at the end of the month, but it defines your bull and bear trends. It's that simple. Again, 401k kind of stuff, not active trading stuff. That was a bull market. It told you right here, the 10-6 was the 10 or the 6 period EMA was above the 10. That's why the histogram was green. Had a crossover right there early on in the bear market, right after the top. It said get out or short, stay short until here. It said new bull market underway. Bull trend, that was the top of the 2007, end of the 2007 bear market, or beginning of the 07-09 bear market. And here, I think you can see it here. Let me move it up. See the red histogram? So what it's doing, it's showing you with very few whipsaws like this one here, it is captured with, again, I'm not going to say perfection, but about as good as you want to get, with, especially if you factor out, because I played around with these things. It took me years to develop all these indicators. No whipsaws. Look at that. Not a single whipsaw since then, since the bear market was over in 09. So this is why I might differ from other people saying that we're just been in one super bull market since the NASDAQ 100 bottom in late 08, and the rest of the markets bottom March of 09. And that trend indicator flipped to bullish and remains bullish right now. But you can see these lines, both these lines, for the first time, they started to flatten out there. I don't know if we had about a flatten out on the 10 period. Can't say if the slope went negative. It came close, but it didn't turn down. Right now, both are negative, pointing lower. We did have them both turning lower right there, and we had a heck of a correction there. But again, it never told us we're in a bear market. That was the down here is another one I use, rate of change 12. Sometimes I'll change it to a ROC 13, and it's a completely different thing. It's not based on the moving averages, but it does a good job of capturing bear markets. And that was the last time it's fired red. So this is what I'm watching right now. Again, these indicators are not on sell signals, nor would they be this early on in a correction, but it appears likely. And again, the takeaway is, if I'm right on my shorter term analysis, daily and even weekly charts, and we do break down, we hit those next targets, this is gonna roll over. And the takeaway is, you guys do with what you want. I'm not in the business I used to be years ago, but I do not give financial advice. I don't tell you what to do. I'll tell you what I'm doing. Call this, this website just a kind of a journal, my thoughts. I share with you what I see, what I'm doing. And then you can take that with your own analysis or analysis of others and decide how you want to trade it. But this is if these long-term indicators roll over, just know that we could be at that point in time most likely be in at least a minimum definition of a bear market, a drop of 20% or more off the highs. But we could be looking at a much uglier prolonged bear market that could last for quite a while. In other words, much more than a year. We could see significant losses in 2022 and even going forward in 2023 and possibly beyond. But first things first, and that is, let's see if we can, take out the recent lows and all the indexes and hit my second target. And if we get there, I'd love nothing more than to go long for the next thrust up in a bull market. That right now you can't write the bull off because these long-term trend indicators. There's been other times where they look like they were going to fire sell signals and they didn't. At the last minute, the lines bounced, and you can see quite a few down here. Look at this histogram. They came down and they really looked like they were going to cross down below the zero line. There, came close there. A little whipsaw there, a couple close calls there, even back here, but they didn't. And so that's what I'll be watching. And it's not going to happen this month, I'll tell you right now. Doubtful. We'd have to have a heck of a correction over the next week, but something that may happen soon. All right, guys, we'll wrap it up here. And like I told you, trust me on this, the Russell 2000, I'm sorry, has fired off most of the same signals, in some cases more than the on trend indicators than the NASDAQ 100. S&P has fired off quite a few on the short term. Those short-term trend indicators are clearly bearish, and it's a little bit behind on the longer-term trend indicators, but we're seeing weakness in the market leaders, and when the market leaders die, i.e. the big FANG stocks, that takes the rest of the market down with it. All right, I'm going to wrap it up here. Get the video out to you guys, and I'll do an end-of-day wrap if anything significant happens today. This has been Randy Finney with Right Side of the Chart. Have a good one.